Even though I get cash negative or break even, or sometimes very little cash positive rental properties, I continue to invest in it. The reason why I continue to invest in it is because these are the kind of stuff banks don't want you to know. They will make every attempt for you to not exercise these kind of options because they hate this kind of seller financing deal, because they want to be the one making that $200,000, not you. So that's why when you do something like that, you need to be careful with how you're structuring a deal. There are special ways to do that. All right, folks, the information that I'm about to share with you is probably going to be the most important video you saw in 2025. I'm about to share something that I have discovered a few years back, and it's going to open your eyes. If you have been told, and the timing of this video cannot be perfect, the big beautiful bill just passed, and it has some very special provision for people who actually take action and apply that in their personal finances. It can change the game for them completely. Most people tell you to buy rental houses, apartments, commercial buildings, land, you name it, mobile home parks, all of it, right? And all of that is sold to you on the name of cash flow. You'll have cash flow, live off of cash flow, life's going to be hunky-dory. You can travel, you can pay your kids with the cash flow, you can buy a car with the cash flow, the whole 9 Robert Kiyosaki thing, right? It's partially right on everything, but they don't really tell you the exact thing they are doing that actually makes them wealthy. So, and I did not discover any of this by learning into some courses or going into some seminar. These are the kind of stuff that you discover on your own. Me and my wife, cumulative, we have done real estate and business all together for the last 15 years. So we together have about 30 years of cumulative experience doing this. So we may know a thing or two. So you might want to stick around. A few years back when the market slowdown happened, we started exploring option on how to maximize our returns on our investment. If anybody's telling you that cash flow is king, and you're gonna get cash flow through your rental houses, they're lying. Go and look at, and if you already have real estate, go look at your tax return. Look at those forms where this shows exactly what kind of the Schedule C of your property, and go down and see how much cash flow you actually had. You never actually get to deduct any of the expenses that you do on a property, and they all keep getting carried forward. Why do they keep getting carried forward? Because your 9-to-5 job is probably exceeding the threshold that allows you to take those reductions. So you're not taking those reductions, they're getting carried forward, number one. Number two, you only have losses. Most cases, you only have losses, especially if you factor in the depreciation and interest payment and taxes. You're left with really nothing. So the whole dream that people try to sell you on, hey, the cash flow, even if you have a couple $100 in cash flow, right, you're gonna burn right through that when you have a turnover. When a tenant leaves and you're trying to find another tenant, you're plowing in a couple $1,000s in the make ready. You're already spending that money that you accumulated for the last year and a half, or 2 years in cash flow. So let me just debunk that, make sure that's also not true. And I am sure a lot of you will agree with me on this one. So what am I here for? What am I trying to sell you? I'm not trying to sell you anything. I'm trying to sell you a concept of what you can actually do with real estate. There's several strategies, right? You can rent your house to somebody. You can do Airbnb, Verbo, short-term rental, mid-term rental. You can do corporate rental. You can do renting it by the rooms. You can do all of that. I have gone the route. I try all of them. And if you are in the game of real estate, you're going to have to pretty much do all of them to actually keep the ball running, because sometimes something's going to work out, something's not going to work out. And you're going to have to figure out a way, right? Market slowdown happened. It's happening right now. Although now interest rates are starting to come down, especially when J. Powell yesterday made the announcement of doing a 25 basis point reduction in the interest. And then they announced that there's going to be further 2 more happening this year. But more than likely, they're going to be another 25 basis points. And then 2026, they might do 1 more. And 27 is going to be all stabilized to where they want to be. And they're probably not going to go any lower than that. But the point over here is, most of the properties that I own right now, I have very cheap debt. And I'm not able to cash flow enough money through those deals. And I know that because I'm a numbers guy. When I actually start looking at my tax returns, my Schedule Cs, I can tell, okay, we're plowing in more money. What can we do? And this is where most people go wrong. You don't review your financials more often, and you're really not able to tell what's going on with your finances, and you are just stuck, paying for a mortgage and keeping a tenant happy, where you are the one who's not making money. Why? Because your bank's making money, which I will get to in a minute. Property taxes, outrageous. Austin, Texas, anywhere in Texas you go, they just bombard with taxes, and they keep trying to come up with excuses to increase more taxes, and they increase it anonymously. If you've ever been into a room trying to protest taxes, you'll find out that there is nothing, absolutely nothing you are able to do to protest the taxes and actually save some money on taxes. We have been able to reduce some a year or so, but then they go right back up the next year. So it doesn't really account for any long-term savings. Then insurance. with all these weather events, the fire, the flood, the hurricanes, the hail damage happen, insurance company wants to recoup their losses where they are losing money elsewhere, and they want to make it from people who are just paying the insurance all their life and not have not one claim. So they punish you for that too. Everything, all of these small things, the HOA, the repairs, the legal issues, the insurance, the tax, the interest, all of this come down to one thing: you, the landlord, who's on the hook to pay for all of this. And if that's how it's going to be, if you're going to do long-term rentals and that's the only route you are going to look at, then you're going to probably realize that you are constantly bleeding money, not getting anything out of it. So what's the solution? The solution is to have multiple strategies to make sure that you can grow your income in ways where you can actually be cash positive and not constantly bleed money. So in this video, I'm only going to cover one topic that I have figured out, and I have had better success in getting better returns. So this is going to be the owner financing strategy that I'm talking about over here. I'm going to break down the numbers so you have a clear idea of what I'm talking about and how these numbers actually make sense for me to continue to do it, and why, even though I get cash negative or break even or sometimes very little cash positive rental properties, I continue to invest in it. The reason why I continue to invest in it is because of taxes. My business or other business that I'm part of, they produce cash flow. They actually produce cash flow. If I don't take any action throughout the year, then that cash flow is going to get taxed and is going to be taken away by Uncle Sam's. So I have to do something. So buying real estate is one strategy that helps me reduce my tax liabilities. We do cost segregation. I'm not going to get into that, but it helps me accelerate all my depreciation all upfront in 1 year, and it reduces my tax bill. But once I do that, I need to worry about how to turn these properties cash flow. If I just lease it out to somebody for regular rent, I'm not going to make much money. It's pretty much going to be break even if I'm paying the lowest interest to the bank. So this is when I started looking into it. Somebody reached out to me a few years back and they said, hey, we have somebody, he was a realtor who reached out to me. He said, hey, can you lend us the house as a rent to own? And the terms I didn't really like, so I went ahead and said, hey, I'm not good with the terms. I'm not good with the terms. What I can do is I can do seller financing, because I had looked into it. And when I actually started doing the numbers for the seller financing, I realized that the whole time people or the media that has been very successful at perpetrating or pursuing or persuading you on buying houses, the American dream, they've done a very good job at convincing you to buy houses, and you bought it. And you bought the idea, and you now have a $400,000 mortgage that you're paying for and you're working for, and most of the money that you make all throughout the year goes into that mortgage. So somebody made a product, they called it mortgage, and they attached it to a real estate that gives them continuous income in taxes, insurance, HOA, and overall upkeep of the property. So somebody came up with a really good product in the whole mortgage, the whole housing industry, and you, the taxpayer, are now buying into it, paying for it, and the person who keeping all this industry alive is you. And this is where the irony is. So going back to the topic, what I did with my house is I decided to look into doing seller financing, and I ran the numbers. I had a very cheap debt, about 4.5%. So the debt was not a problem. It was going fine. Somebody who had approached me, they didn't have the best credit. And the realtor said, okay, this is the kind of clients they work with who don't have the best credit. They want somebody to finance the house for them so they can buy it. They own a house. I was like, good. Okay. I had the house for some time, and I wanted to liquidate that so I can 1031 and move that money into a bigger deal. So I said, okay, let's look into it. I started doing the numbers, and it was eye-popping. I was like, I am getting less money in rent every month, and I am spending more money in taxes, more money in insurance, more money in repairs. Whereas if I just become the bank, the lender for my buyer, then I will actually have more income coming to me. I'll have more interest payment coming to a month than the rent itself. And in almost 10 years from now, I will have had all of my money recouped from the buyer, and they would still have a mortgage. Mostly all of the principal balance is owed. So they have paid very little towards the principal, and me as a lender has accumulated most of my money in the first 10 years. And I don't have to worry about insurance. I don't have to worry about taxes. I don't have to worry about repairs. I don't have to worry about any of the external stuff happening. If the house burns down, the insurance is going to give them enough money to rebuild their house. My mortgage is going to continue. So when I buy houses with a mortgage and I hang on to them for 4, 5, 6, 7 years. You don't have to hang on to them for that long, but most of mine are that long, right? Almost 10 years going into most of them, and I'm still buying. But once you have that, you have built enough equity in the houses, and the prices have risen to 2 times the price you paid for the house. You're easily able to finance these properties to somebody. They are buying it from you. You are their bank. The interest payment is all you are getting, and you are not worried about any other liability. And this gives you a net cash flow situation where you turn a non-cash flow situation into a cash flow situation by playing it differently. The numbers are real. I mean, I have these numbers in front of me. I'll show you here right now in a second. So I'm going to go ahead and show you these numbers, but you can also run this number on a PITI calculator from any mortgage company, or I think FCC has one. I think SEC also has one, but you can find these tools online and you can check the numbers yourself. But here is the house that I sold to a buyer for $410,000. My cost based on the property was close to $285,000. So after buying it, after repairing it, I ran about a $285,000-ish, and I sold it for $410,000. The buyer, when they bought it, they made a down payment of $82,000, and I financed the rest of it, the $328,000 at 6.5% on a 30-year note. So I gave them enough time to pay the mortgage, so they don't have to rush or try to refinance in 4 or 5 years. Kept it simple, but this is how it affected the numbers. Okay, the monthly payments came out to be around $2,073. This is just interest and principal. It does not include the taxes, insurance, or HOA. The house didn't have an HOA, so there was irrelevant over there. But in this example over here, on the first month, out of the $2,073, $1,777 just went into interest payments, and only $297 went to principal. And if you run an amortization schedule just like this on the computer, you will see that the numbers that you get is going to be close to $21,200 in some change in the first year interest alone. Can you actually cash flow that kind of money? This is just interest. Can you actually cash flow that kind of money when you rent a house to somebody? No, you cannot. But you are over here getting $21,212, and about $3,066 went to the principal. That's a lot of money that you just earned, and all the principal that has gone within the very first year is only $3,666. But here's the interesting fact. If you sell a house according to seller financing 1 year after the purchase of the property, then you're not taxed with short-term gains. You're taxed long-term gain. And that long-term gain on $3,066 is going to be very minimal compared to selling a house altogether and have to pay taxes on it all lump sum, or you have to worry about doing 1031 exchange. But what if you accumulate small payments like $3,000, $4,000, $4,500, $4,600, and if this kind of money keeps getting reported as principal, this is all the money you had to pay tax on. And if you go further down the list on amortization schedule, you can see on year 5, the total amount of interest the individual who bought, or the buyer who bought the house from you in the seller financing terms, has given you close to $103,000 just in interest alone, and only $20,000 of the $238,000 has gone to the principal. Further down, if you go 10 years, you received almost $200,000 in interest payment, with only $49,000 gone to the principal. And if they actually keep the entire mortgage for 30 years, which by the way is a proven number, proven stats, everybody knows about this. People buy houses all the time. Every 4, 5, 6 years, people move. That tells you is by 5 or 10 years, if they sell the house, you would have made couple $100,000 in interest alone, and they're about to pay you back all the principal because they sell the house. More than likely, there will be some appreciation, and the buyer is going to walk away with some money. But you are walking away with $200,000 in interest payments, give or take, for something, for a property doing cash negative month over month, month over month, month over month, or breaking even. You just generated yourself a couple $100,000 without lifting your finger if you actually paid attention to the strategy. These are the kind of stuff banks don't want you to know. They will make every attempt for you to not exercise these kind of options because they hate this kind of seller financing deal, because they want to be the one making that $200,000, not you. So that's why when you do something like that, you need to be careful with how you're structuring a deal. There are special ways to do that. You can leave your email below, and I can send you some instruction on how you can actually structure the deal yourself, or how I structured it. And there's no cost to it. I'll share exactly what we did and what kind of terms we did. That way you can apply that into your own business and turn that sucker that's sucking money out of your life and also blood out of your body into a cash producing machine. And you are helping the buyer, you're helping yourself. You don't have to worry about tax, insurance, repairs, roof, leak, hail, tornado, fire. You don't have to worry about none of it. You just have to make sure your buyer keeps a good insurance and that your management company is going to take very well care of it. Your buyer is probably never going to even contact you in future because all of the work is going to be done by a management company and they are going to take care of all the responsibilities of collecting money, reporting money in taxes, blah, 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 all of that. So this is how you convert a loss-making deal into a profit-making deal and make it actually a passive income source. I hope that helps. I'll see you guys on the next one.